So how do you play this market? Don't sell all of your stocks. I had a couple emails saying, Frank, you're saying that the market was going to crash. It was going to come down a lot. If you listen to the whole presentation, so if it doesn't crash over the next 3 weeks, it's definitely going to crash over the next couple months, and it's going to come down really sharply. And you have to be careful because you always see moves like this. Like when we have one of the biggest months in 25 years, 30, whatever, how far back you go, you don't see that in normal markets. So if you look at our portfolios, it's not what we did. We didn't sell every one of our stocks. We sold some positions, maybe about 20%. But the rest of the names that we have in the portfolio have pricing power, strong growth profiles, good management teams, trading at reasonable valuations. But stick with the industries that have pricing power, which are what? Healthcare. Government's going to continue to pay their bills in a lot of healthcare companies. People are still going to get sick. Energy. Consumer staples that we've seen. I like uranium here. I really like coal. I see the coal statistics. I'll break that down with Daniel tomorrow. Holy cow, forest coal. Unbelievable. Unbelievable numbers that they're not allowed to report because everybody hates coal. It's amazing how much demand. Wait, those coal companies that we hated. Wait. Just keep them turned on for a little longer. We need you turned on for a little longer. It's kind of funny when you see those numbers, which are amazing. But like I said, uranium, I like just the demand supply imbalance. Now we see how important uranium is to electricity, especially in Europe. I like travel-related stocks, since the money consumers are spending is mostly going to experience and vacations instead of discretionary things. Clear data showing this. I've seen it firsthand as I travel. Went to Vegas, how crowded it was. Sectors to continue to avoid housing. Housing's dead. I mean, you might see pockets where, and listen, these guys are some of the smartest management teams in the business. I've really, really followed these guys through 2006, 7, 8, 9 into the credit crisis, how they were able to get a government adjusted and carry losses for 3 years, which a lot of people didn't know, and it resulted in one of the greatest buying opportunities. Those were one of the sectors that actually absolutely took off because they got hit the hardest in housing. So these management teams know what to do, know what to cut, but profits you're going to see go down dramatically. I just talked to someone in my neighborhood who's in the industry. I talked to a lot of real estate agents. I want to hear from you guys who are real estate agents in your areas, in your neighborhoods. But this person is close to one of the biggest home builders, and they said that 50% of orders for lumber have gotten canceled. So they're not looking to, but they're building out the current contracts, which they have to do. But after that, look out. I know there's still not enough supply in the market, but people can't get loans at 7%. It's a massive payment. They can't afford it, which is why you're not going to see rental incomes come down, but the rental market come down as fast as everybody believes because people need to live someplace. So they're going to rent instead of buy. So you're going to have pricing power in rentals. Tech, much of tech you have to avoid. Not all of tech, but a lot of it. You're going to see clearly, you're going to see some really cool winners and management teams that do the right job, and you're seeing growth and they're cutting the right areas. And others are just, so used to spending for the last 10 years that they still haven't cut back, like the Metas and Googles. But all these names have exposure overseas where it's not just slower demand's going to hurt them, but also it's a higher dollar. And you say, well, the dollar, it's not temporary. I mean, do you think the global market's going to do better with higher interest rates? I mean, the amount of debt they're carrying in terms of debt to GDP makes us look amazing. So they're going to continue to flock to the dollar. And I told you about those profits where it's 20% of operating profits that have gotten cut due to the dollar for Nike. And Daniel and I covered other companies. I mean, you're seeing even technology. And when it comes to Microsoft, I mean, you look at billions of dollars off of revenue simply because the dollar's higher. And that's not going to stop anytime soon. Less money you bring in the door, and that means profit's going to go lower. Don't buy gold yet. Unless you believe the dollar's going to fall from here. I think we're getting to a level where we're close. I think it's down 6 or 7 straight months. I love Bitcoin here, especially since if we're looking at past 3 months, it hasn't been correlated or even as volatile as the rest of the market. We're usually used to seeing like 17,000 and 24,000. I mean, we know how high it was over 60,000. It's volatility. It's hard to put something where it's that volatile and that crazy where you're looking at it, especially if you're comparing it to gold, which is kind of like the younger person's gold allocation. And it is. Everyone's growing up digital. That's the way it is. You talk to anyone under 40, they're like, gold what? Unless you live like in Canada and Vancouver and stuff. Plus, Bitcoin and crypto for the first time ever is going to have exposure to trillions in retirement assets. You didn't have that. This is Fidelity, BlackRock, which is calling Bitcoin as an asset class that investors can purchase through their 401ks and retirement accounts. I would avoid a lot of media companies, cable companies, streaming. Disney's going to come out. They're going to pad their numbers like they always do. Should easily beat estimates, revise significantly lower into the quarter. But at the end of the day, streaming is an extremely tough business. We're looking at movie theaters and stuff like that. Don't have pricing power as much. People bringing in their own food to movie theaters. And I'm definitely not an example of that. I'm the guy that pays for $50 popcorn. I'm just kidding. But a lot of people do bring in food to the movie theaters, but you're seeing margins get hurt. And it's a very expensive business to operate, and you only charge them per month. And now people are more busy than ever, and they're not home as much watching. So you could give away your service for free and say you have 200 million subscribers. At the end of the day, they're not going to pay for a service, especially with Disney, where you can't put your best content on it because you need it to come out in the movies, which is Marvel. And now, everyone that you gave the service to free, you're going to throw commercials everywhere all over it. So what do you think is going to happen to those subscribers? The operating losses, the more subscriber Disney adds, the more money they lose. Just look at the numbers. But Chapek's is going to continue to go down this road. They have to get out of streaming. If they don't, Disney's going to be tough. They're going to they'll beat the numbers, and it'll go higher, and Kramer will be the cheerleader again, and it'll give you a good opportunity to sell it short. Because, I mean, those numbers that they're reporting right now, even into next year, I think it's like now down to 450. That 450 number, that's on average. It was supposed to be like $7 to $8. That's what it was 2 years ago. But they were supposed to earn 450 2 years, like just right out of COVID. Bad COVID number, and then in 2021, early 2021, and then we've got like 7 quarters where these numbers keep getting revised lower and lower and pushing out further and further and further. Why? Because the operating losses behind streaming are insane. Hulu has been around forever, and it's still losing billions. It's an extremely, extremely tough market. Disney has great assets other places where they do have pricing power, but if they can continue to focus on streaming, on commercials, and on shit, it's going to be a terrible platform. It's not that good right now, unless you want to watch Dumbo 80 times. But the new content is Netflix. When you have new content coming out, that's when you rush to these platforms. Disney, a very little new content, Star Wars and stuff like that, but their greatest content, the greatest content on Netflix, HBO, it comes out on their platform. The greatest content for Disney doesn't come out on their streaming platform. It comes out to the movies. So it's interesting, but I would avoid a lot of these companies. People are not watching as much. They're more busy. They're not as home as much. Plus, there's tons of competition to stream and to be entertained through so many media channels, even TikTok, which, again, results in not having pricing power. But the most important thing you could do right now, been saying this like crazy, is learn how to buy long-dated puts. These are options that are very easy to purchase through your brokerage account. It's simple. You just got to get the approval. It takes a day, and they'll give you the approval. See, level 1, it might be level 2, I think I heard from maybe a couple from... It's not a problem, though. You can only lose the amount of money you put in each option. Why is that important? Because, say if you believe the market's going to come down sharply from here, and look what happened in October. We have a massive rally. If you short the market, you got annihilated. You're sleeping on a park bench. It's not what you want to do. But long-dated puts, you have a year you're betting out. You're betting against a stock falling by 15% from your cost basis. Basically, over the next 12 months, you want it to happen sooner rather than later. But if they fall further than that, I mean, you could see 300, 500% returns on this option. And they could explode higher. But you have a pretty long duration. So well into 2023 with these long-dated puts, where the market is probably going to be more volatile than any other time I've seen in my 30-year career. You're removing tons of liquidity from the market. The Fed's going to continue to raise rates, so you don't have them pushing more money into the market. China's is who knows what China's going to be. And they couldn't even report their GDP numbers on time. Then they report them late, and then you have people fact-checking them because one thing you can check is the exports. Obviously, it was a lot lower than it came out, right? We're used to China, but now we can actually pinpoint how wrong they were. So you see much slower growth there. But again, no Fed help, inflation not moderating. I mean, it's a little bit coming down in some areas, but still, I mean, this JOLTS number is not a good sign. And all the companies that are beating are telling you how much they're raising prices. So how are we going to see inflation come down? Especially when in the CPI, it's calculated the wrong way. Rental incomes, food, energy accounted for what? More than 55% of that index? And those prices aren't really coming down. But the strategy allows you to be long with your current equity portfolio. So many of you have stocks that you're going to hold long term and have dividends, while also have a shot to make a killing if you think some stocks and ETFs will fall next year. So you think 15%, wow, you know what, Frank, that's a big number for a stock to fall. It happened in one day. to some of the best companies in one of the biggest rallies, one of the biggest months we've seen in decades. Hey, Meta, Google, Snap, I can go on and on and on. But if you go back to previous, Comcast, FedEx, VF Corp, down more than 30% just last quarter. And a lot of these stocks have rebounded off their highs. So you have a massive opportunity when it comes to buying long-dated puts as part of your portfolio. Makes sense.